Not every company is, going to survive and thrive, but shares in general are very likely, in my opinion, because history tells us, to go much higher from here over the long term, and that's the only time frame that people should be worried about. Half of my brain is like, I'm losing money, this sucks, so much red. The other part of my brain, and this is the important bit, is the bit that says, but hang on, you knew this was going to happen. You know it's happened before. You know it's going to happen again. Dollar cost averaging for the win. Buying shares on sale is what we all think we want to do, except when they're on sale, we panic.
Welcome to Shared Lunch, brought to you by Sharesies. At Sharesies, we're on a mission to create financial empowerment for everyone, which is why we have these conversations. They're a big part of being able to dig in to the different topics that are affecting investors and to get experts along to share their view on it. So I'm Sonia, I'm one of the co-founders and co-CEOs at Sharesies, and today we're joined by Chief Investing Officer at the Motley, Scott Phillips. We're going to chat about all things US tariffs and the upcoming election and how this is impacting Australia. Before we get started, I want to acknowledge the Gadigal people of the Eora Nation, the traditional custodians of the land where we're coming to you from today, and pay respects to elders past, present and emerging.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Hi Scott, welcome to the show.
Sonia, thank you, and thank you for having me.
Yeah, great to have you back. So I'm just going to jump straight into it. Is now a good time to invest?
Yes, absolutely a great time to invest, but with a massive asterisk, mate. The asterisk is I have no idea what happens next. So maybe the market falls 20%, maybe it rises 20%, maybe it goes nowhere for a year. I have absolutely no idea. So how can I say it's a great time to invest? That's a really, really simple one. Here's what history tells us, and this is really important. The ASX, the US markets, developed markets around the world have never yet failed to regain, then surpass a previous high. So here's the thing, if that holds true, now it may not, I can't give a promise or a guarantee. If it does hold true, that means there's upside from here to get back to the last high, and then more upside again. Shares relative to where they have been are on special. So do I know what's going to happen next? No. Do I know which companies? No. And by the way, when I say shares, when you ask the question shares, I'm talking about generally across the market. Not every company will go up. Not every company is worth buying. Not every company is, going to survive and thrive. But shares in general are very likely, in my opinion, because history tells us, to go much higher from here over the long term. And that's the only time frame that people should be worried about.
You mentioned that, things have been dropping over the last wee while. Largely, one of the things that's driving this is the tariffs that have been put in place by the US. And so we're looking at 10% for Australia as a baseline. What impact are these tariffs having on Australian companies?
Let's work out what's going on. So the tariffs that have been put in place are I'm going to be pretty honest here, and I'm going to be pretty upfront. I'm going to ask your listeners to trust me on the process here. I don't have a political dog in this fight. Democrat, Republican, Liberal, Labor, I don't care. What I will say to you is economically, these tariffs are a terrible idea and a terrible solution to a reasonable problem. And just because you've identified a problem correctly, which is, hey, there's some problems with US manufacturing, doesn't mean any answer is always going to be necessarily correct. I'm sorry for the hardcore Trump fans out there, it's not true. Again, it's not a personal view, it's not even a political view, it's just an economic view. So what's happening is Donald Trump's announced tariffs on much of the rest of the world, and I'll get back to Australia and New Zealand by extension in a minute. But the impact of those tariffs are going to be almost certainly higher prices for US consumers. Why? Because when we say we're putting tariffs on Chinese products, we're not really saying we're putting tariffs on China. We're saying American consumers, or Donald Trump's saying, American consumers are going to pay more for Chinese imports. Or, by the way, the newly competitive US-made stuff that's more expensive than it used to be, but can now compete at those higher prices. In other words, no matter which way you cut the sausage, you're paying a higher price for those goods. Higher prices mean inflation. Now, I don't have to explain that. We've been through 5 years of it over the last half decade right around the world. High inflation is bad. High inflation may also lead to, and most economists and frankly even the Atlanta branch of the US Federal Reserve are expecting the US to enter a recession this year. If the US enters a recession, they are the world's largest economy. They're the world's largest consumer economy by miles. If the US has a recession, it's going to put meaningful downward pressure on economic growth right around the rest of the world, including down here at the bottom end of the globe in Australia and New Zealand. So that's the setup, and it's important setup because when you say what's going to happen to companies here in Australia, there's three ways to think about it. The first is that global story, the global recession risk. If the US demands less, Australian companies may produce less. If Australian companies produce less, their profits are probably going to fall. Now that's a modest outcome. If there's a lot less, we may well see companies fail. We may well see job losses. And I'm an optimist, by the way, but I also want to tell it straight. So that is the possible outcome. That is the worst case scenario, probably, if this does get to that nth degree. So that's the first order impact. The second order impact is, of course, the impact on Australian companies directly. We know there's 25% on Australian aluminium and steel. There is 10% now on everything else going to the US. If you have a meaningful proportion of your sales that go to the US, they are going to be harder sales to make. Maybe you absorb the increase and make lower margins. Maybe you pass on the increase and have lower sales. There'll be a few companies that can pass on the increase and still sell the same amount. That's the best case scenario, but it's probably a small group because price elasticity matters. If you put prices up, people buy less. So that's the second order impact for all those businesses that are exporting to the US. And by the way, those companies reliant on those other companies. If you're supplying a company that's exporting to the US and they buy less, they're going to buy less from you. So that matters. Third order impact really quickly is China. China is Australia's largest trading partner by heaps. There are ongoing tit-for-tat reciprocal tariffs as the bullies bash each other, over their head. Trump said overnight, recently, a couple of days ago, they are going to maybe put 50% tariffs on Chinese goods on top of what they've already announced. Why? Because China had the temerity to basically bash back at the US putting tariffs on it in the first place. And this is the silliness of what's going on. But if China's economy slows and Chinese steel production slows, guess what? That's going to hurt Australian iron ore exports meaningfully. That's not a big economic impact, by the way, because iron ore impact doesn't employ a whole lot of people, but big impact for share prices for those iron ore exporters. I own shares in Fortescue for full disclosure. Bad news for those miners, bad news for government revenues, and for gross domestic product for economic output. So there's three kind of concentric circles, if you like, of potential outcomes from the tariff war when it comes to what's going to hit us here at home.
Are there any particular areas that benefit from the change?
No. I mean, if you stretch and you squint really significantly, you might find an opportunity to find one or two. What you might see happen is Australian companies find other markets for their products, for example. We saw when China put massive tariffs on Australian winemakers found other markets. It wasn't easy and found some. Some didn't find any at all, by the way. And we've got a massive wine glut in Australia. So is there upside from that? No. If you own an ASX listed company that happens to do business only in the US and somehow is able now to make more money because it put prices up because imports are more expensive, maybe there's a little bit somewhere there in the nooks and crannies. It's a really, really small sliver of potential upside. And frankly, even then, those companies are more likely to be hit by US economic pain more broadly rather than tariffs particularly. That is, if inflation goes up, if economic growth falls, if US unemployment rises, those companies that are based there are probably going to hurt. And by the way, that's why we're seeing US share markets fall. You kind of think in the way that the simplistic version that Trump and others like to present this, tariffs go up, US business gets better, US companies make a lot of money, US people get employed, therefore it's all wine and roses. The reality is the US market has absolutely tanked for a couple of straight days, late last week, early this week. Why? Because those investors are worried about the profits of those companies because of the economic harm that these tariffs will do domestically. I'm looking long term, which, by the way, is still why you go back to your first question, why I'm still massively optimistic. So if my investment horizon is 5 years plus, and it is, that's post Trump's term. So again, thinking about what's happening now, this week, this month, it's scary, it hurts, your portfolio falls, it just sucks because no one likes the uncertainty. But if I'm a long-term investor, and I'm looking at 5 years and going, if companies are bigger and better in 5 years than they are now, despite what they go through in the meantime, they're worth buying. And so that's the lens I really want to impress on people. Think about what's happening in those number of years out there. Don't worry about just the short-term stuff between now and then.
We track investor sentiment through the quarters, and over the last quarter we've seen it move from what was pretty balanced into cautious territory. What are you noticing from investor sentiment and long-term planning?
Now, when we went through COVID almost exactly 5 years ago, weirdly enough, we looked at market fell in Australia 38% from top to bottom in a month and 4 days. Now that felt scary as heck, right? That's just really, really scary. And I don't blame people feeling scared because what if COVID was bigger than it ended up being? What if the death toll was massively higher? And that would be obviously far more tragic than the financial impacts. What if the economy's ground to a halt for longer? What if? And I get all those concerns, right? Except in hindsight, we know it was the fastest bear market in history. And then the fastest recovery in history. So when you think about, are people cautious? Yes, absolutely. I'm seeing exactly the same thing, mate. They're just like, I got to get out of here. This is scary. One thing I want to remind people is, remember, for every seller, for every so-called panic seller, there's a buyer. You can't sell shares unless someone buys them from you. And so when we say, everyone's selling, Well, they can't be because everyone's also buying. There's always two sides to a trade. So while we focus on the declines, and yes, there's more panic in the sellers than there is excitement in the buyers. Otherwise, the price will go back up. That's why we get it with price falls, right? That the sellers are keener than the buyers are. Everything finds its market, finds its price. And millions and millions and millions of shares are changing hands, being bought by people who are saying, hey, this is okay. So yes, there's cautiousness out there. There is fear out there. There's uncertainty. I get why people are worried about it. So I want to validate that because it's really, really important. The active investing through COVID, I've told this story before, Sonia, and I may have told it even to you guys. I hope I didn't. During COVID, there's two sides to every investor's brain, right? There's the bit that says, oh my God, what's happening out there? This is ridiculous. And a policy perspective, I have very strong views, as you already heard. From an investment perspective, though, I've got to have two parts of my brain. Half of my brain is like, I'm losing money. This sucks. So much red. I'm down again. Maybe the market's right. What if this is the time that it's different? I'm freaking out here. What if it keeps falling? Maybe now's not the time. Maybe I should wait till the coast is clear. All those fear emotions, all those uncertainty, all those worries, they're going to be there. What if I'm investing too early? What if I'm wasting money? All those things are in my head. The other part of my brain, and this is the important bit, is the bit that says, but hang on, you knew this was going to happen. You know it's happened before. You know it's going to happen again. Dollar cost averaging for the win. If you've got some money to invest, if you can find great companies, you think they're going to be better in 5 years' time, then you know what? That is a great thing to be able to do. Buying shares on sale is what we all think we want to do, except when they're on sale, we panic. And so two parts of your brain, acknowledge the fear, acknowledge the uncertainty, acknowledge the concern, and then say, but I'm investing anyway because I just have to confront it, ignore it, do whatever you need to do with the fear. But invest anyway because long-term, that's proven over and over and over and over again to be the right approach. Again, not in every company. Quality companies, diversified companies, across currencies, across exchanges, across industries, businesses with good balance sheets, all the good things that we've talked about before about good investing. Keep doing that stuff. Don't buy indiscriminately, but keep buying anyway.
What are the key metrics that people should be keeping an eye on to see how things are going?
So I've got to say, Sonia, this is where there are really easy but wrong answers to that question, right? And if you speak to short-term traders, if you speak to people who are going to try and sell you a thing rather than hopefully educate you about an approach, they'll give you lots of great metrics. I have exactly zero metrics in the short term. Why? Because think about every recession we've ever lived through, and I've lived through a few. The market goes down, share prices go down, sales go down, profits go down. If you're looking for the recovery to happen, by the time the recovery happens, it's too late. I've told the story before about some really, really smart, wealthy investors who sold everything at the beginning of COVID and said, I'm not going to buy back in until the pandemic is over. Now, the pandemic took 2 years to be over, and in fact, it got worse before it got better. But as lockdowns happened, economies shrank. As that happened, the stock market recovered. So if you're looking at the rest of the world, this is why the economy and the stock market aren't the same thing. If you're looking around the world, you're saying, well, tragically, deaths have increased. Illnesses have increased. Hospitalizations have increased. Lockdowns have happened. People are barred from entering and leaving countries. Economic activity has stalled. Governments are keeping us afloat with welfare money. It's getting worse. And yet the market recovered and recovered and recovered and went up and to the right. Not in a straight line and not without doubts and concerns, but it did. If you waited until a vaccine, you missed out. If you waited until a pandemic was declared over, you missed out even more. So I'm gonna politely not answer your question because honestly, the only metrics you need to be thinking about, and I guess there are, but they're not really metrics in terms of what data am I seeing happen. I'm trying to, as an investor, look forward and say, I'll pick a year, in 2030, I'm going to pick a business. In 2030, are they going to have more stores? Are they going to sell to more people? Are they going to find new ways to add categories? Are they going to keep their costs under control? Probably yes. And if that's the case, are they going to be mostly more profitable in 2030 than they were, I'll say last year, let's not include this year because what happens, than last year? Yeah, probably they will. Okay, well, if that's true, how much should I pay for that business? And I can, no matter what your approach to valuation is, you can pick a rough price, a rough multiple, a rough whatever you want to base your valuation on to say worth buying or not buying now based on where I think it'll be in 2030. Let's say it's a year-long recession. Let's say it's really bad, year-long. And it goes from the middle of 2025 to the middle of 2026. And sales fall by 50%. Now, is the company going to survive that? If it's got a good enough balance sheet, yes. If it's got good enough cash flows, yes. Okay. If I'm comfortable, they will. And you shouldn't assume, by the way. Do the work for yourself. In the middle of 2026, they come out of recession. And sales suck and they're losing money. But they start to improve over time. And over that period of time from 2027, 28, 29, things get back to normal. And again, I look at it and go, right, well, by 2030, even if they've gone through a recession, even if sales and profits did get really ugly for a while, but they survived and then came out the other end, are they going to be bigger and better? Okay, what's a fair price to pay for those businesses now? So don't wait, is my opinion, my advice, for the metrics to come through, start by saying, what do I think about the business? Do I like it? Has it got a good brand? Has it got a good future? Will it have those in 5 years' time? Yes. Okay. What's it worth paying today to get that benefit in 5 years' time? That's the entire lens I use for my investing.
Yeah, great. So alongside all of this, there's an election coming up in Australia. So what's again, another moment of uncertainty that does ripple through into the markets. What's been most interesting to you so far in the lead up?
Australia still has a very large budget deficit, and it's projected to get worse based on the most recent budget handed down by the current incumbent government. And that's not good for Australia. That's worse in the US, by the way. They've got massive foreign debt issues, massive government debt issues. So fiscal being tax and spend, right? The fancy word that economists use for government spending and taxation. The tax and spend settings are misaligned, and how that nets out does actually have an impact on the economy. We're supposed to run surplus in the good times, deficits in the bad times, supposed to offset each other. The tax and spend settings actually really matter for long-term prosperity. So I'm keeping an eye on how much they're spending, really honestly. What is interesting too is the focus on the short term. So we've got one side, the incumbent government, putting cost of living relief through extension of energy subsidies, electricity subsidies, effectively a discount on your energy bill. The opposition's promising a reduction in fuel excise for 12 months, sorry. These are really short-term solutions. So I got to say, from an economic perspective, my view has always been that as an investor, I care far more about the long-term settings of the country than about the short-term opportunities or risks to the individual businesses. Now, when I say risks, I don't mean existential risks. If something's going to go broke, I really care. If it's like, well, tax rates for companies are slightly higher or lower, or tax rates for individuals are slightly higher or lower. But if I'm a long-term investor, what I care most about is my companies have the opportunity to operate in a really, really solid, healthy, growing economy. And so, honestly, when I look at the election, I'm not looking at who's going to give more money to this industry, $5 for that, $10 for that. By the way, I'm not a top-down investor. I'm not a macro investor at all. But policy-wise, I would like to think the government that comes into power post-election is going to fix the budget bottom line. They probably won't, but I'd like to think that. And they're really genuinely thinking long-term about setting the country up for the best long-term success so that we can all thrive. And if we all do, companies have more people to sell goods to. They have richer people to sell goods to. Even people on low incomes have more money to spend on. I mean, it's a really beautiful virtuous circle if they get it right. The sugar hit is exactly what it sounds like. It's good for a little while and then goes away. So those are kind of the things I've been kind of focusing on. There's not a lot specifically for individual companies or industries. We'll have to wait and see kind of what comes from that. What is interesting at the moment is both sides have been reasonably restrained in terms of new spending announcements, I think, because they realise where the budget is. But there's also a lot of cost of living pressure, as they call it. And the policies are laser focused on making us feel better about ourselves, so we'll vote for them.
Yeah, on that, what do you think's top of mind for Australians going in?
I'm no election analyst either, but it's been meaningfully different over the past 6 months to the last 2 months, even the last month. The government was on the nose, the opposition was in the ascendancy, government was getting tagged with cost of living pressures. I have to say, in the last kind of couple of weeks, and again, I make no predictions, I'm no election analyst, but what's been really interesting is the government's clawed back some ground, whether it's because the RBA started cutting rates, whether it's because we've got used to inflation, frankly, whether it's because the Trump stuff is so scary, we just want the better the devil we know. I don't really know. And again, this could change between now and the election date, but we've seen some meaningful swings back to the government on a bit of it's gone from kind of pure cost of living to, yes, cost of living with a bit of this feels a bit scary. Is it time for a change? So if you asked people, I suspect they would still say it's all about cost of living. We know Australian real wages are actually really, really poor. They've fallen more than, I think, any other OECD country, certainly much lower than the US, the UK, and the average for the OECD. I don't know the New Zealand numbers at the moment, I have to say. I should know them, but I don't. So we've seen that kind of happen, and the cost of living pressures are probably worse in terms of real incomes, real being what you get, less the increase for inflation. If I have a pay rise of 5%, inflation's up 6%, I've gone backwards by 1%, so my real wage has fallen 1%. That's what that term means. I know you know that, Sonia, but just for your listeners and viewers. So yeah, we've gone backwards in real terms more than almost any other country, and that was really, I think, playing in the opposition's hands. Cost of living, fix it for me, make it better. I have to say, in the last couple of weeks, we've also seen Peter Dutton, the opposition leader, reverse his view on working from home, for example, and sacking public servants. They are two things that ordinarily would have played really strongly to a right-wing conservative voter base. Rightly or wrongly, I make no value judgment, just an observation. They've reversed course on those because they're losing votes on them, and I do wonder whether there's a bit more of a band together in the circumstances we find ourselves, these kind of tough economic and geopolitical circumstances, rather than the divide on party and policy lines. I don't mean the LNPs being divisive. Both groups just kind of, the tribes reverting to their corners. It does feel like there's more of a considered middle to be won by the major parties. And I suspect cost of living is first and foremost, but also that idea of who is best placed to weather the storm that's coming from the US as a result.
What can retail investors expect or how do elections impact the markets?
So what markets tend to respond to, we've seen this in the last couple of weeks, is markets respond to uncertainty, but more importantly to the unexpected. And I guess what I mean by that is this horrible phrase called things are priced in. If the market knows there's going to be tax cuts in a month's time, just pick an example. The market will say, okay, we think people will spend more money then, and so the tax cut gets priced in. People foresee that increase, and the price goes up in anticipation. So the things that we know are already priced in, at least in theory. The tariffs that were surprise announcements are why the market fell, because we all kind of thought, well, Trump might do some tariffs, maybe, possibly, we'll see. And that's why we've seen it fall. The election will move markets only when either a party wins who isn't expected to win, or a party unveils a policy or set of policies the market's not expecting. And so, generally speaking, we don't tend to see much movement in markets or even individual industries most of the time if there is either a change of government or a return of an incumbent government. Because the things that differentiate those two parties, I saw some numbers from one of the big economists, Chris Richardson or Shane Oliver, I can't remember who it was, I think it was Chris, said something like 99% of the spending of both parties is exactly the same. In other words, they differ only on 1% of the government budget. Now, those differences matter if a company's going to get some money or an individual is going to get a tax cut or something, so it matters. But most of the spending is the same across the board. So unless you're in an industry specific or a company that's going to benefit or be hurt by a policy that's announced, and even then, it's already probably priced in unless the party is not expected to win and they do. So not much. The last thing I'll leave you with, Sonia, is in the US, there's been some work done by Morgan Housel, like a great writer, an ex-Motley Fool employee for the record. He's done some, basically over the life of the US stock market, 1900 or so onwards, there's been literally no significant difference between the party in power and the average returns of the stock market during that period in power. And so that's really important to think of, because we have plenty of, if Trump's elected, he'll do this. If Dutton's elected, he'll do that. If Albo's elected, he'll do this. They'll do those things. But statistically, at least, the odds that the party in power make a meaningful difference to the stock market subsequently, it's line ball. There is no meaningful difference. There's a lot of people who have this view of if party X wins, then the market will do well, so I'll buy, or they're going to wreck the party Y wins, going to wreck the economy, so I'll sell everything. It just isn't the case very often, and so I really would encourage people, separate your politics and your investing.
Anything else that we haven't covered about the election or tariffs, really?
I think so. A couple of things. The people who are supportive of Trump's tariffs say, well, other countries have done it before. Yes, they've always been around, and I guess I'm kind of harping back a little bit on what I said about the tariffs, but if you kind of go back and say, so what? And then what? And then what? The best way to inoculate yourself, by the way, against this stuff is learn some history. I don't mean boring history. I don't even mean economic history. I just mean history. Things improve over time, despite stuff. So the Australian share market's gone up 9% a year on average, 8 to 9% since about 1906. Credit Suisse put some numbers out. By the way, the ASX was the best performing stock market over that period of time, which is pretty cool, but only by a hair's breadth against the US. Now, roughly 9% a year. They say 6% a year, 6 point something, 6.4 I think it was, before inflation. So you add inflation back, you're roughly 9, give or take. And that happened despite all of these things. 2 world wars, the Korean War, the Vietnam War, 2 Iraq wars, the war in Afghanistan, the Great Depression, recessions before the Great Depression, straight after the Great Depression, before the baby boom, and then for every 7 or 10 years ever after, oil shocks in the 70s, the GFC, the dot-com crash, the 87 stock market crash, stagflation in the early 80s. If I feel like I'm giving a laundry list, I haven't been alive that long, but I've done the history. My point is that over time, things go on to be better and bigger. Why? Because human ingenuity, you mentioned this before, Sonia, unless we've hit peak ingenuity, unless we've hit peak human development, human capacity, human potential, I haven't even talked about AI, we won't, but man, think about the opportunities that are coming for companies and for people in a world where computer power is just phenomenally larger than it ever has been. If you're a brave person to say, yeah, we hit peak capitalism, we hit peak ingenuity, we hit peak development in 2024, it's going to be rubbish ever after. I mean, maybe it will be, but geez, is there much chance of that? Not really. So really, please look through the tariffs. Invest well, invest in quality business. We talked about that, but please do that. That's the point of the biggest takeaway of the tariffs, I hope, despite all the time we spent on it, is in hindsight, they will, I think, not be as consequential to your wealth as you might feel looking forward, because you can't see through them yet, right? So dot-com crash, Nasdaq like 85%. It was an enormous wipeout, right? Huge. And yet, Nasdaq went on to new highs. The Dow, the S&P went on new highs. The ASX went on new highs. It wasn't the be-all and end-all. Now, I don't like them. I don't want them. I'm not saying we should have them if we could avoid them. Of course we shouldn't. But if you can't avoid them, the next best thing is to say, they're here. What's the best way to make the best of them? And there's likely to invest anyway. I think on election, I've probably covered enough of that, mate. The best thing, as I said, is to separate your policy or your political brain from your investing brain. Don't overthink it. Don't extrapolate too much. I've seen plenty of commentary on Twitter. Oh, this party will kill the economy. This party will kill it. And then, by the way, both say about each other because that's just what we do. It's not going to happen, right? Are some better or worse than the economy? Maybe, probably. Do we know that yet? I don't even know if we know that yet. But, more broadly, despite governments, despite crashes, despite tariffs, despite all this stuff, human ingenuity works, right? Churchill said democracy is the worst system except for every other system that's been tried. My version of that is democratic capitalism, right? For all of its flaws, for all of its problems, and I would fix them if I had the choice. Maybe treasurer for 6 months is all I'd need. But despite all those things, it still goes on to create enormous wealth for people if you are part of the system. Why? Because it harnesses all that human capacity and potential.
I think that people are really, the wealth of experience now that we have been through a few of these things. We've caught up over the years about the different periods of market volatility. Mm-hmm. So, is there anything you want to leave people with before we wrap today?
The future is bright. The future is bright. Optimism wins. For all the doomsayers, for all the doom and gloomers, for all the perma bears, for all the people who are, it's raining, the sky is falling, Chicken Little style. You know what? Bits of the sky fall all the time. But the sky isn't falling. The future is bright. We will go into bigger and better and brighter things. You and I will be talking in 5 years' time, Sonia, and I would bet a reasonable amount of money. The ASX has hit another high, probably another 2 or 3 on the way through. Maybe it's even fallen another 10% on that journey and come back up again. Vanguard have a great chart. I've banged on about it before. It's called their 30-year index chart. $10,000 invested in 1994 was $130,000, hypothetical amount. 10 grand became $130,000. Despite all those things I talked about that happened over that 30-year period. Right? A 13-fold increase, despite the wars and the terrorisms and the recessions and the COVIDs and all this stuff. Now, if you added money regularly, you're going to have even more than that. Now, I'm not saying that'll be the next 30 years, who knows? But also that average rate over that 30-year period, not dissimilar to the 30 years and the 30 years and 30 years before that. So the future is bright, optimism wins, look through the clouds and make sure you can see the long-term value being built by companies and people right across the world, and particularly on our stock exchanges.
So one thing that did stand out from the data was around optimism for Australians, and a group that felt less optimistic were younger Australians. Do you have anything to kind of share on that, or what might be factoring in there?
I honestly, I started investing relatively early, but not as early as I should have, and I hate young people because we have our own podcast, and I regularly abuse them when they very, very good naturedly when they write in, because they've got things. I want their time, right? I want to go back 30 years. I want to go and invest more. I want to set myself up even better because I know not because I know what the future did bring, but I know what the future can bring. If you're a young person, I get. By the way, why do you feel bad? Housing is ridiculously expensive. You've just seen your superannuation fall. You haven't been through these market cycles before, and you're like, oh my God. This is investing. What are you people mad? Why would I do this thing, right? Why would I feel good about this? So I get that. I absolutely get it because, again, the one benefit of age, other than dodgy knees and less hair, is you kind of have been there before and you see it, right? You've seen it happen. So yeah, I'm incredibly envious of young people because they've got all the time in the world, whether it's through superannuation or compulsory savings, whether it's through their own investing, just the passing of time, right? I am so optimistic. I've got a 29-year-old and an 11-year-old, 12-year-old now, and I am so jealous of their future because they have got an amazing future ahead of them. Think about the technological changes, what's going to happen in the world. Man, can you imagine it? And yet they've got the time to actually enjoy that and invest now. So what I want to say to young people is retirement feels a very long time away. That's why super is so great, because it makes you save when you're 19 and you don't want to. And I'm yet to hear someone who's retired who hates superannuation. Plenty of people working do. Oh, why do I have to put this money away? This is terrible. It's horrible. I would rather spend it. They get to retirement and go, oh man, I am so glad there's superannuation. So if you're a young person listening, please stay the course. Please believe that the future is bright. Please believe that we have a system of democratic capitalism for all its failings, and we're failing you on house prices right now, and I would change that if I was in the Treasurer's chair for a while. But investing will work for you. It will build wealth over time. I can't give you guarantees. I'm not allowed to give you promises because otherwise the regulator will yell at me. Let me just say, in my very, 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 very strong opinion, the future is very bright. You have so much time on your hands. The last message is please keep contributing, whether it's adding to your own super or contributing, investing in your own name through shares or otherwise. please keep investing because the compound returns you get over time. If you're listening, you're 25 now, you're probably going to live till you're 95. And no, retirement's not the end. The retirement date is not the end of your investing, right? It's about 2/3 of the way through your life. So you've got 75 years to compound. That is, do the maths on that, by the way. It will blow your mind. And so yes, please be positive. Please be optimistic. I know it feels like it sucks. Take it for an old person. Things will get better. They will deliver plenty of returns. Your compound returns will be spectacular. Stay the course. Keep investing. It'll be absolutely worth it. Your retired self will thank you, and maybe you might even think of me when I'm long dead and in the grave.
I love that, and it gives me a chance to slip in my favourite Warren Buffett quote, which is someone sitting in the shade because they planted a tree many years ago. So,
I got a T-shirt with that on it, Sonia. I wear a T-shirt with that quote on. I love that quote. It's so good.
Which is exactly what you're talking about, right? Like, you don't know it at the time, but, over time it pays off.
Plant the tree, baby. Plant the tree. You know it.
Thanks, Scott. And thanks, everyone, for tuning in. You can watch the episode on YouTube or listen in on your favourite podcast app. Leave us a message or comment about what you'd like to hear in future episodes.